Before this meeting began, we ask that everyone at this time please silence your cell phone. The Fort Bend ISD Board of Trustee meeting is an open meeting for the public to observe the board conducting district business. Therefore, patrons may only address the board during the designated audience item section on the agenda. If you have printed material you want to give to board members, you must provide them to Board Secretary Gary Rosenthal or to me, and we will provide them to the board. We also ask that members of the audience be respectful of others and remain quiet during the meeting so that everyone is able to hear the procedure. Thank you.
Thank you, Officer. The time is 5:59 p.m. and the meeting is hereby called to order. We have the presence of a quorum and the meeting has been duly called and notice of the meeting has been posted for the time and manner required by law. Before we begin this meeting, I would like to acknowledge that today is Veterans Day, as we all know, a day to recognize all persons who have served in the United States Armed Forces and have risked their lives for our freedom and to keep our country safe. Let's not forget to say thank you to a veteran for the service and sacrifice. In honor of Veterans Day, the Dulles High School Air Force Junior ROTC will present the colors and lead us in pledges. We will also have a moment of silence. Please stand.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Honor the Texas flag. I pledge allegiance to the Texas, one state, under God, one and indivisible. Now let us observe a moment of silence.
Thank you. You may be seated. Once again, thank you to Dulles High School Air Force Junior ROTC. Before we begin this evening, I wanted to ask if there was any other veterans in the room, if you could please stand. Thank you all very much. First on our agenda this evening is going to be our first quarter financial report for 2019-20. Dr. Dupree.
Yes, sir. Brian Gwynn, our Executive Director of Finance, will present that report this evening.
Good evening, Mr. President, members of the board, Dr. Dupree. A copy of this report was provided to you. I don't have a formal presentation. The good news is there is nothing out of character or bad to report. So what I'd like to do is just point out to you a couple of highlights that are worth mentioning. The first one is you may have noticed that our enrollment is trending higher than the demographer's moderate growth. We had 77,226 students that were projected, and we are actually at 77,663 as of September 30th. So that will result in additional state revenue. The other thing that I would point out is that we have redirect or added staff where it's appropriate to address that higher than anticipated enrollment growth. In terms of the financials, as I mentioned, at this point, we are 3 months into the year is the closing of that first quarter. There hasn't been anything out of character that specifically needs to be pointed out, and I'll be happy to answer any questions that the board may have.
Do we want to do this right now, or do you want to complete it and then go for questions?
I think he's done.
Yep.
Okay. All right. Go ahead, Mr. Rice.
Mr. Gwynn, so I have a response here. Can you state for the record that you expect to end the year in the black?
Based on what we are seeing right now, I wouldn't say we can definitely say that we will end in the black, but what we would say is that we have seen some positive adjustments to revenues that were not expected. I would just mention the additional enrollment we saw. And in addition to that, the difference between the preliminary certified roll and the actual certified roll came in about 0.5% higher, which represents about an additional $2 million in revenue. So what we're seeing is a positive projection. And then typically what we see on the expenditure side is we forecast conservatively in terms of, or budget conservatively in terms of expenditures. And generally speaking, those expenditures come in less than what we're expecting. So between the additional revenues and lower expenditures, I would say that would balance out. Typically, what we do is we begin our forecasting in earnest in terms of how we expect the year to end in December, and at that point, we would have a much clearer picture of whether or not we expect to end in the black or in the red.
All right, well, thank you. I did notice there were some areas that we were over and that we've been over in years past. Dr. Dupree, how are we handling our group health insurance? Are we still self-funded?
Yes, sir, we are self-funded, and we're actually having a great deal of discussion about that right now because of two reasons. One, the tension between United Healthcare and Methodist as they're trying to negotiate terms, which has affected our organization. But also because next year is the year we actually bid for the new administrator and all of those contracts. So we're going to be, we've been contributing about at least $2 million a year to the plan from the general fund. So right now it is in the positive trend upward that we're in the black right now on the plan, but we're going to be bidding all of that and adjusting everything for the objective of being able to save both the employees and the district money.
Have we ever considered going to a policy and not being self-funded?
We have. We actually had that conversation last week, and what I've asked them to do, Gallagher is our consultant. I've asked them to really do a true comparison, a projection of what that would look like next to self-funding. I mean, I think all of those of us who've done this for many years know self-funding is really the better way to go because we manage it, but I think it's wise to at least run it and see and do that comparison.
All right, thank you. Thank you, Mr. Gwynn.
Thank you, Mr. Rice. Any other questions? Thank you for the presentation. Moving on to our comprehensive annual financial report.
Okay. So the district recently completed the annual audit with our external auditor, Whitley Penn. And at the audit committee meeting, I will say our board president did give this a resounding endorsement by saying he was very excited about the outcome of this report. So I don't want to keep you in suspense any longer. So without further ado, I'll turn it over to our external auditor with Whitley Penn, Mr. Chris Breaux, and he can give you those findings.
Thank you, sir. Mr. President, members of the board, and Dr. Dupree, thank you for having us out tonight. I know you have a big agenda. A lot on your agenda tonight. We're going to run through the results of the audit and the comprehensive annual financial report. We've listed here our engagement team this year. We'll start at senior manager with Laura Lynch. I was your engagement partner, and Mr. Tom Peterson was your engagement quality control partner. We also have the seniors and staff accountants included on the engagement. From a required communication standpoint, and these are things we've talked about. Get me in the microphone. There we go. This whole process began January 10th with an engagement letter that you have approved. Our audit was performed in accordance with generally accepted auditing standards and governmental auditing standards. We've confirmed that we are independent of Fort Bend ISD. And we wanted to talk a little bit about the estimates used in your financial statements. As I always like to say, not every number is backed up by an invoice or a check. There are estimates made in your financial statements. You have the estimated lives of your capital assets, your buildings, your buses, etc., your pension and your other post-employment benefit liabilities, related items, allowance for uncollectible property taxes, and your state aid estimates. Your staff has come up with appropriate ways of making these estimates, and we are comfortable with the estimates they have made and presented in your financial statements. We are unaware of management consulting with outside other auditors, other accountants, or opinion shopping, and we've had no disagreements with management or difficulties during the audit. There are required certain parts of the audit are what we refer to as required supplementary information, and to refresh your accounting or auditing skills here. It's the management discussion analysis, the budget to actual for the general fund, pension information, and OPEB information. This information is subject to audit procedures, but we do not express an opinion on these particular statements. There's supplemental information, which are your combining statements and your TEA required schedules, in which we do express what we refer to as an in relation to opinion to your financial statements. The audit process ultimately results in the auditor's opinion. This begins with our risk assessment, taking a look at your controls, your operations, your environment, to see where things could go wrong, what might happen to your financial statements. We look for discrepancies in the financial statements that are material as they relate to an error or fraud. It doesn't matter. They're both the same to us. We want your financial statements to be right. From there, we work on testing of controls, and we can test the controls that the district has in place to make sure that your financial statements are materially correct. We go through a verification, corroboration, and confirmation process with various third parties to, again, see that the informations have some backup and will stand the test of time. And then we do substantive analytics in your financials. What happened? Did you have more students? Did you get more state aid? Did property values go up? Were there more property taxes? That kind of thing. More employees. We have costs in healthcare and various things similar to that. All of that go into our opinion, allowing us to form an opinion on the financial statements. You have received an unmodified opinion on page 27 of the Comprehensive Annual Financial Report, which is a clean opinion of the highest level of assurance we can give. I'd go into qualified or modified opinions and disclaimers of opinions, which are possible, but you do not have those. So you did good, and we're going to leave it at that. Your statement of net position, this is your government-wide financial statements. This is prepared on what we refer to as an accrual basis of accounting. It represents everything you own versus everything you owe. You'll see that your total assets and deferred revenues were up about $200 million to $1.7 billion this year, ended June 30th, 2019. Your total liabilities and deferred inflows were up to $1.9 billion, up about $200 million from the previous year. If we take a look at our net position, what's left, 85 million of that are net investments in capital assets. And that's capital assets, building, buses, equipment, less associated debt with that. You have restricted net position of $73 million, and this is going to consist primarily of food service and debt service, primarily debt service revenue, debt service fund balances, net position set aside. You do have unrestricted net position, a deficit of $345 million. This is primarily due, this is almost entirely due to your portion of the pension and other post-employment benefits through the Texas retirement system. We went into great detail with this with the Audit Finance Committee. Let's talk about the pension and OPEB liabilities. OPEB or other post-employment benefits, TRS care liabilities reflected in your government-wide financial statement represent a mathematical allocation of liabilities from a statewide cost-sharing plan. The district's allocated portion of the statewide plan is determined by dividing the amount of contributions to the plan by the total contributions for all participating entities, as well as the state of Texas. These liabilities have always existed in your financial statements until the recent adoption by the Government Accounting Standard Board of certain statements. There's no way to show what your liability, your portion of this plan was. With the advent of GASB 68 and 75, you don't have to remember those. With the advent of those standards, it has a way of slicing and dicing these particular liabilities, the pension liability and the post-employment benefit liability. So the net effect on your unrestricted net positions for the last 3 years are shown. Your net OPEB, pension and OPEB liability in 2017 totaled $484 million. It was at $411 million in 2018 and $438 million in 2019. So this is a number you watch. This is the way that you split the liability between the state and the districts all across the state. This has a very similar effect on all of the school districts in the state of Texas. Cash and investments held by the district as of June 30th total $348 million. $29 million of that was U.S. Treasury bonds and notes. U.S. agency securities amounted to almost $60 million. $213 million were invested in public funds investment pools, and you had cash and deposits of about $45 million at year end. Your bonded debt began the year with $1 billion in bonded debt. You had additions of $343 million, and you retired $246 million through a refunding. You ended up with $1.1, almost $1.2 billion in outstanding debt. And that's made up of $1.1 billion in general obligation bonds and $100 million in deferred amounts. Those are premiums and the like there. The ratio of your net bonded debt to total value, assessed value, was 2.74%. What does that mean? If we take a look where you were in 2010, the debt to valuation is the red line there. In 2010, you were a little over 4% or 4.25%. In 2019, you are again at 2.75%. So your ratio of debt to your valuation has actually dropped over the last 10 years. The next two lines are taking a look at your debt per student in the green, which is over on your right side there, and that has dipped a little and stayed and come up some. The debt per student in 2010 dollars, so if we keep the debt, if we adjust it for inflation, your actual debt per student has dropped over the last 10 years. So our debt per student comparisons, and this goes just through 2018 when all this information was available for these different districts. You are the green line going across there, and you can see your debt per student comparisons are remain about the same, around the $15,000 per student level, a little bit lower in 2018. We have other districts at the top there. In the purple is Lamar Consolidated, then Katy in blue, Cy-Fair in the red with the triangles, and then we put Alief ISD down at the bottom. These are other local districts. Debt to valuation comparisons here. These are your numbers, and you can see the clear drop here from 2009 to 2018 from the 4 3/4 to the 2 3/4. You're again the green line, and everyone follows pretty much the same. The top three districts there, along with our fast growth districts, and so it's a good comparison. The statement of activities. This year we had something strange happen last year with the advent of the GASB 75 or the other post-employment benefits, and we ended up with a negative revenue on behalf revenue. It's very odd. It took me a while to get through that, but I'm through it now. So we have your 2018 numbers as presented, and then an adjustment to 2018, what they would have been without that $120 million negative adjustment. So it gives you a little bit better comparisons of what happened over the comparison between the last 2 years. 2019, your total revenues would have been $900 million, and your less OPEB adjusted amount in 2018 would have been $822 million. The bottom line here, on the accrual basis, your net position decreased by $23 million to the negative $186 million we saw on the previous slide. Your governmental expenses, and this again is at the government-wide level, 55% of it is instruction and 7% is instructional leadership, so that entire instruction combination there comes out to 63%. The next items that take up a lot of your expenses are your support services and your student support services at 16 and 14%. Your general administration, if your overhead, if you like, is at 2%. Now let's take a look at fund balance comparisons. Now our fund balances are maintained on the modified accrual basis, which is a working capital basis, near cash basis. Your total general fund balance went from $201 million to $238 million. Your non-spendable fund balance is those prepaid expenses and inventory numbers. You had committed fund balance of $84 million, up from $72 million. Your assigned fund balance stayed about the same, 4.2, 4.0, and your unassigned increased from 119 million to 146 million. And this specifically was some additional Harvey funding that was received. I don't know the exact amount on that. 21.9. Yes, thank you, ma'am. So that would allow for that increase there. All of your other funds, your $5.2 million is essentially going to be your school breakfast and lunch program. You have a debt service program, which is healthy at 78%. And you have a committed fund balance of $3.8 million, which are the school activity funds. And you have an unassigned fund balance of a negative $29 million, and that has to do with your construction fund and how you fund that through the commercial paper, which is actually a liability because it's current. It's a liability of the fund itself. Those amounts go away as you issue bonds and retire that commercial paper in the short term. Here's your general fund balance over the last 10 years. You can see the green lines there are your unassigned fund balance, and the red line are the stabilization commitments over the past 10 years. Yeah, I believe that began in 2015. So you can see how that number, you have a healthy fund balance there in your general fund. The general fund, just some more detail here. General fund balance increased $36.5 million to $238.1 million. Unassigned fund balance remained approximately 2.5 months of annual expenditures, or 75 days of annual expenditures. Committed fund balance for state and economic stabilization had a balance of $73.9 million, 1 month of fund balance plus budgeted loss for fiscal year 2020. And your property tax revenue in your general fund increased from $390 million to $411 million, primarily due to property values. In your debt service fund, your debt service fund balance represents 89% of projected 220 debt service payments, but that also includes the debt service payment that you have in August. So that number appears high, but you've got a payment that comes due in August to make that happen. You had refunding bonds totaled $231 million for the year, and your property tax revenues, similar to the general fund, increased from $96.5 million to $102 million. Your capital projects fund deficit fund balance of almost $30 million. The deficit is expected to be resolved by future bond issues. Deficit balance due to expenditures accrued in the fiscal year 2019 that were paid within 60 days of year end. The balance of your commercial paper outstanding is $1 million, is shown as a fund level liability, and you had construction related expenditures of $129.4 million and new building bonds of $60 million. So a lot of activity happening in your construction or bond funds. Internal controls and compliance. There's a separately issued single audit report We have no findings to report on internal controls over financial reporting or compliance, such as procurement, public funds, investment act, and spending requirements. No findings to report on internal controls and compliance over major federal programs this year, which were your special education cluster and your disaster grants from public assistance. And with that, I'd be happy to answer any questions you might have.
Thank you very much for that presentation, sir. Mrs. Haliger, do you have a question?
Yes, thank you. I'm not up to all my GASB, is that correct? But I do just kind of, if you could help me understand on page 7, when I look at total net position, because it has, I guess, decreased.
It has
decreased.
decreased.
It has decreased, yeah. That's good.
Means your liabilities have increased.
Yeah, exactly. So I guess my question is this increase or decrease, is this normal? Is this something we should be seeing? What's the trend? I mean, what's...
Well, yes, ma'am. So if you take a look at this, this is page 8, and you can see you have an increase in the effect on net position from 2018 to 2019 of about $27 million, from 411 to 438 million. And if we recall, I know no one recalls, but if you go back to that number, if you see in that first column, you decreased, third line from the bottom, you decreased your net position by about $23 million. So that change from 2018 to 411 to 438, or $27 million, would account for that decrease. If we take a look at this $438 million in deficit and apply it, and I'm jumping all over the slides, and I do apologize for that. But if we go back to page 7 and we take the $438 million and apply that to your $345 million negative unrestricted, thank you very much. If you apply it to that, we're going to do some math here, but that gets you in the, I'm going to say, in the $80 million positive standpoint. So those liabilities will hold, those liabilities will make that number negative.
It might be good though, because it might be good though to go back and address her specific question about, is that what I heard you ask, is that a healthy trend or a good trend or a bad trend?
Yes, because, I mean, I'm looking at this, of
And-
course, if I see it decreasing,
Yes.
you know.
The other thing, Mr. Brow would suggest is, because I know you did a good job with the committee of talking about OPEB, but I'm not sure the other 4 board members had the benefit of that explanation of what that really
Yes, sir.
is.
Yes, sir. So the answer is yes, this is the trend we're seeing. So if you take a look at this page right here, you will see that your portion of the total OPEB and pension liability, your slice of that state liability, which is a cost-sharing plan at the state, and they figured out a way mathematically to assign you some of that, that number is increasing because the overall liability of the state increased. And so as that pie got larger, yours pie got larger.
And it might
So
be-
you'll see
excuse
this
me,
trend.
But it might be good to also reinforce that that's because our enrollment base in TRS, the retirement system, also grew.
Correct.
That's
So
a
there's
direct
two,
reflection of our number.
there are two factors in there. One, the overall plan has a larger liability, and two, your contributions into the plan increase, and if your contributions increase, then your portion of that plan increases as well, the liability.
Yeah, okay, thank you. I do understand that piece of it. So, let's say 10 years down the line, am I to expect that our total net position will continue to decrease? Is there opportunity for it to level set? Is it opportunity for it to increase? I'm just trying to understand when I'm looking at a decrease, and I understand the reasoning why, right? And I'm looking at 2018. I just want to know from a net position of a school district, is the expectation that we will always be in a major negative like this? Is that a good question? No.
So a pension plan has, there's ins and outs. So we can do one of two things. We can put more money in at the state level, because that's where it happens, or you can pay less out. And that's or you can pay less money out.
Okay.
And that's how you reduce a pension plan. And so the trend would be that unless there is more money put in, that this number would continue to grow.
So, but based on that statement, are you saying that the only reason why that this net position stays negative is because of our TRS?
That is correct.
The only
Yes, ma'am.
reason?
Yes, ma'am.
But I do want to come back, though, to her prevailing question, though. You're talking about the impact of OPEB on the bottom line.
Yes.
What about capital assets, long-term liabilities?
Right, so
Because that really is also a driver as to whether it's going to remain flat or go further.
right, so let's take, if we can, let's take a look at that. So this is a comparison in 2 years of your, if you look at the bottom in your net position, your net investment in capital assets is that $1.1 billion number of capital assets, almost, 1.1, and then you have a $1.6 billion of long-term liabilities. Some of that, not all of that is capital assets. I think we looked at that being 1.1. So those numbers are netted out here on the bottom line here. So your as long as your debt has maturities that are equal to or less than, if you will, the amortization or the life of your assets, you should remain positive in that particular area.
Does this include bond debt?
That does include bond debt.
So
specifically bond
theoretically,
debt.
as we sell the entire bond issuance, though, we could see continuing decline in net position then, because the liabilities are going to continue to.
Well,
increase.
as you sell those bonds, the cash that you get from those bonds, the proceeds will become capital assets. So those will be offsetting those bonds.
So I think I heard, I'm gonna need a Gatsby for dummies here, is that the position right now there's an opportunity for it to get better. And I think I have to take some of that question offline, because that last explanation kind of just did like this.
Well,
I apologize. You don't have to take the time here, but yeah.
But it's a matter of that funding, that bottom line funding there is I will tell you, is driven by the state. How much money they're putting in the plan.
Yeah, but you've got all these other liabilities and.
You do have those other liabilities, and those are all offset.
Yeah.
So you have the liabilities are offset, your capital liabilities are offset by your capital assets. You have some non-capital liabilities which are offset by cash on hand.
But
Accrued
theoretically,
compensated
as you
assets.
pay off your debt, though, your number's going to be more positive.
Your number's
Because-
going to be more positive, except that at the same time, you're expensing that capital asset, and you're depreciating it over time. So your debt, right now, when you issue bonds and you build assets, you've got two big numbers here, and they both dwindle down as you go through.
Okay. Thank you.
Thank you, sir.
And we can certainly talk offline too, and, okay.
Mr. Rice.
Well, Mr. Bro, just one last question.
Yes,
So, am I to understand the OPEB number is an accounting number that we get from the state? So we have to record that, otherwise it would show our financial picture 80 million in the black, as you were pointing out. So here's the question: when does the bill come due? When does the bill come due for OPEB?
Well,
Or is that
when does the
slot?
OPEB, the OPEB, other post-employment benefits, which is TRS care, post-retirement benefits, that comes due as folks retire and pull money out of the plan. There's no one's going to ask you to write a check for, where's my number there, $323 million to fund this. This is coming out of the plan. And so that check becomes due as they get more money from the districts, as they get more money from the state.
So we just have to account for that in our financial statement.
That is
Okay.
correct.
Thank you.
You're welcome.
Ms. James?
So let me see if I understand that. So the state has a liability because they promised the TRS plan. The districts have paid into it as they have. But the plan is not fully funded. So the state has said, we're not going to show that on our books. We'd like all the individual districts to show it on their books. And they've divided it into pieces, and this is the number that they've given us, which causes us to have the deficit balance.
Well, that would be a great story. That would be a great explanation of it, except that the state has probably about half of the liability is on the state's books.
Okay,
So they're not just cutting it out and saying we're pushing it down to you.
Okay.
This has the method for doing this is through Government Accounting Standards Board. They're saying, okay, the way you'll do a cost share, how do we split this up? Well, we're going to split it up by how much you pay in. Okay, if they pay in 50% and all the states, all the districts paying 50%, then 50% of the liability is yours, 50% of the liability is the districts.
Okay, so then what I hear that saying is it's an unresolved issue at the state level. The funding for this plan is unresolved at the state level. It's an interesting number, but as you said, no one's going to come and ask us to write a $323 million check, because that's impossible. So it's unresolved. It's unresolved how the TRS system can be funded going forward, and we show a piece of it on our books as a negative.
Yes, as does the state. You have a pension plan that is basically statutorily defined as to the contributions.
Okay, thank you.
All right. Thank you very much for the presentation. I just wanted to make a few points here to make this easy. So management did a good job, as stated, right? So I'm backing up why I say this is exciting, Mr. Gwynn. The debt ratios look good, right?
That's correct.
And along with the valuation comparisons with other districts. So are we in good shape, and are we moving in the right direction?
That is not necessarily what the auditor tells you, but I will tell you you are moving in the right direction.
Thank you very much. I appreciate it. All right, let me look at the agenda here. Thank you, Mr. Breaux, for being here.
Thank you, Mr. President. And you did say that the administration did a wonderful job, and they did do a wonderful job. We do appreciate all the information they give us so that we can do our job and report to you the results of the audit. So thank you very much.
And if you don't mind, Mr. President, I would think it'd be appropriate for the accounting staff who are in attendance to stand and be recognized, because they work very hard all year.
Thank you again. We will now convene in closed session under the Texas Open Meetings Act, Chapter 551, and those sections listed in the agenda, and for the purpose of private consultation with the board's attorney on any or all subject matters authorized by law. We are now convened in closed session.